Welcome back. We're here to have our monthly live market commentary, and this is where we talk about the latest developments in the market, and this is where also we share our thoughts on them. I'm Albert. I'm the Deputy Country Manager here in Malaysia. I will be your host for today's session, and we are joined today by Stephanie, our Chief Investment Officer. Hi, Stephanie. How
Hi,
are
Albert.
you?
I'm
Good.
good. It's getting warmer and warmer in Hong Kong, so switching to a summer outfit now.
Yeah, speaking about changing, like things changing, I think in the last 1 month, we've seen a lot of things changing itself. Look at, in March, we have had four mid-sized US banks. They had to be rescued. We had some issues too with a large Swiss bank in Europe. So yeah, it's been very, very, very exciting times, probably very nerve-wracking for a few. We've also seen depositors pull their money out of small banks and put it into large banks. So yeah, Stephanie, can you give us probably our listeners here a quick recap of what has happened in the last 1 month, the various events that had led to this banking crisis of confidence?
Yeah, I mean basically, I think that the train of events actually started way back last year, and I'm sure we're all aware that the Fed has been increasing interest rates very significantly, and also at a very fast pace in 2022. So total of 450 basis points of interest rate hikes, which in a historical context has been very fast. Now, I mean, there are consequences of these interest rate hikes. If we kind of roll back, the whole reason why the Fed was increasing interest rates was indeed, I mean, they wanted to slow the economy down. So they actually wanted to trigger some sort of turbulence in the economy, so that like things slow down, hiring slows down, people kind of don't have that much spare cash to spend, and therefore would not keep pushing prices higher. So I think we're seeing some signs of that. I think that actually started to things actually started to have issues in earlier this year. The banking crisis was also a combination of a slowdown in technology companies. Now we all know that like last year, a lot of technology companies actually suffered from various issues. Namely, for example, if you look at the tech stocks in terms of their valuation, they have come down significantly. Funding for a lot of these companies have also dried up. So for the tech companies that are not, as well positioned for the economic cycle, they're running into problems. So there are concerns about the tech industry as well. And Silicon Valley Bank and Signature Bank are the two most used institutions by these tech companies. And also a large, significant amount of the deposit base actually also comes from Silicon Valley, as the name suggests, right? So when the customers have issues, and when there is also a concern on the bank's own kind of balance sheet and the health of the holdings in treasuries, a lot of their customers, namely the tech companies, they withdrew at the same time. So that caused a classic bank run when there's a loss of confidence and people all withdraw money at the same time. The bank actually have their customer deposits invested in some of these long-dated government treasuries, which we know because interest rates are going higher, their values actually have declined. So in short, the bank did not have enough collateral to meet all these customer withdrawals, and it ran into problem. Now, it could have spiraled into much bigger kind of banking confidence crisis, because that's how like banking crisis spread, right? When there's a shake of confidence in one bank, people start to question, oh, what about the other banks, right? What about all the other regional banks in the US that are not systemically important? What about my deposits that's not guaranteed? So I think this time around, compared to, for example, 2008, the Fed has learned its lesson, right? They have actually come out very swiftly over the weekend to announce backstops to stop the crisis from spreading further. Namely, they are providing liquidity to all the smaller banks so that they would have short-term liquidity to fulfill any withdrawal requests from the customers. So that helped to restore confidence, and that was pretty much kind of the end of the spreading of a much potential contagion that could be much bigger. Now, of course, is there no consequence from this? In finance and in economics and economy, there's always these chain events. And one of the bigger consequence is that for the smaller banks and even for the larger banks, they are starting to tighten their lending standards. Right? They are actually looking at how they're lending money to companies, particularly the small, medium-sized companies. And in the US, actually, their economy is made up of a lot of SMEs, these smaller sized companies. So we're already starting to see some more, more stringent requirement on lending and refinancing. And for some of these companies without a very good business model, without sustainable business model, they would have problem, number one, refinancing, finding a bank to lend money to them. And then secondly, even if they can lend money, if they have to refinance, last year, these companies were borrowing at like very, very low interest rates. And this year, they have to borrow at much higher, right? 500 basis points higher, even much higher. That actually poses challenges for a lot of these smaller companies. Time goes on, some of these companies would have to start cutting costs or even would need to shut down. And I think eventually that will get reflected in the US employment number and also the economy's, ability to spend money. Of course, for a lot of companies, the last thing you want to do is to cut your staff. So you would try to save like as much cost as possible before you start to cut staff, which is why, we're still seeing non-farm payroll numbers or employment numbers actually quite strong in the US. But if you look at some of the leading indicators, like the PMI, it's already been in contraction territory for a few months, and it's not getting better. So I think at the end of the day, there is no banking crisis like 2008. And I think central banks globally have shown that they're very, very quick to act. So the probability of spiraling into something that's much bigger is quite small this time. But it doesn't mean that, the economy is actually in very, very good shape and it's all clear from here.
Thanks, Stephanie. I guess taking that a little bit further, because we've seen a lot more cautiousness coming out of the US itself with this whole banking crisis, with smaller banks especially really tightening their lending standards, which ultimately impacts small businesses. Do you think this could lead to an economic recession that everyone has been talking about?
Yeah, I think if you look at some leading indicators like monetary kind of conditions, they have tightened significantly in the wake of the mini banking crisis, and that's why the Fed actually did not raise interest rates by 50 basis points, right? They raised it by 25 basis points at the last meeting, because some of that tightening has already been done by the tightening of the private credit. Actually, if you look at the Fed's own forecast, they are actually forecasting unemployment to rise significantly. And the implication of that is that the Fed actually also forecasts a recession themselves. And you may ask, isn't the Fed supposed to be kind of protecting the economy? Why are they forecasting recession? Indeed, they are the one who is triggering the recession. And because when they need to fight inflation, they don't have a lot of tools, right? They can only control the supply of liquidity and then also try to slow down the economy such that inflation starts to come off. Because when people lose jobs, again, there would be less price pressure in the economy. And I think last night we just saw the latest CPI number. On surface, the headline seems to be actually a bit softer than expected. It came in at around 5%. But if you look at the core inflation, which strips out energy and food, some of the more volatile components, it's actually still very high. And more worryingly, actually, some of the components like used cars are starting actually to pick up. So there is, the Fed has not achieved its goal of fighting inflation. So in the Fed's mind, they need to trigger a recession. The question is, how deep is that recession going to be? And when the recession actually happens, how quickly can they actually come out and save the economy again? And I think that actually depends on a lot of their policies going forward. If you look at the inflation numbers, they are starting to come down already. So the Fed just needs to, I think, keep at it, keep to be hawkish to kind of tame inflation, such that in a few months' time, maybe when inflation is kind of closer to the target of 2 to 3%, then they can afford to have more slack to kind of stimulate the economy again. But of course, a lot of things are quite uncertain. There's a lot of moving parts, and not to mention, like, I guess, on one hand of the equation is demand, the other hand of the equation is supply. We've seen like OPEC actually came out a few weeks ago saying that they are reducing supply. So it's not just, I mean, the Fed changing of interest rates that's affecting things, and we need to consider like every, I guess, all the moving parts.
Yeah, I think as a result of all these things that has been happening, there has been a wild change in expectation for interest rate hikes and cuts. I guess after yesterday's data itself, we've seen, well, at least it's quite likely that we're going to be seeing a 25 basis points hike in the next Fed meeting in May, after which I think market is looking at about roughly 60 basis points cut in interest rates. So yeah, based on what you just mentioned, Stephanie, any thoughts on the path of interest rates going forward?
I think I mean, what Powell has mentioned is that they will take interest rates above 5% and pause there. He actually didn't explicitly say that they will start to cut interest rates in second half of this year. And indeed, if you look at their forecasts, they are not kind of forecasting any interest rate cuts until next year. The market has been kind of, I guess, more aggressive in pricing in these rate cut expectations. I think for investors, if you think about what the market is saying in terms of interest rate cuts of 60 basis points, that's basically, I guess, not a very good scenario, because for the Fed to cut that much in that quick period of time, there would be some more crisis like what we've experienced in the last 2 months. So in any case, I think the market has shifted its concern from inflation to growth, and how bad, as like Albert mentioned, right? If we get a recession, how deep or how bad that recession is going to be. I think as investors, we need to prepare for that, right? And we need to think about how we position our portfolios to weather that in case it comes.
All right. Thank you, Stephanie. If any of you have questions based on what Stephanie has been talking about, do feel free to post them in the comments bar. We'll get to them afterwards. But that's on the US side of things. I think what had also happened, which was pretty significant event back in March itself, was that we had the latest NPC meeting in China. This is where all the highest officials in China meet up to set their targets for the year. And the target set for this year itself, 2023, GDP growth of 5%. So this was the market expectation was actually for something a bit more ambitious than 5%. So Stephanie, for yourself, were there any particular key takeaways from that meeting?
I think, again, if we think about China in terms of the history of economic cycles since the financial crisis, it's actually quite telling, because in 2009, China came out with a big stimulus, and that was actually, from a China policymakers' perspective, creates a lot of long-term problems, because that was what fueled the bubble in the property sector, which, I mean, took a long time to resolve, and also a few other speculative bubbles, for example, 2015, the Asia bubble. So, I mean, China policymakers have actually learned from this, and I mean, they are very cautious in how they stimulate the economy. Because if you look at China's GDP, kind of debt to GDP ratio, it's actually increased significantly. It's also very high. So I think what we've seen since fourth quarter of 2022 was also PBOC injecting liquidity. But the reason why they injected liquidity is because the China economy is slowing so much, such that, I mean, there is actually a risk of more systemic damage. So I would say that it's a put that the PBOC has put in, meaning that they don't want things to like fall under the floor, but they also don't want property prices or asset prices to go exuberant as well. And I think what we're seeing now is that stimulus that has been put in has been tapered, and the Chinese policymakers are, quite content with a kind of an economy that's not too hot, not too cold. And I think if we think about the relative cycle of US versus China, I do think that relatively, China is actually coming out from a long period of economic contraction. Now with the reopening after COVID and also like the stimulus that have been put in since the fourth quarter, on a relative basis, you can see that, for example, the China PMI are now above 50, right? They have been trending about 50 for 2-3 months now, which means that the economy is actually expanding. Whereas the US economy is actually going into a contraction. So there is a difference in terms of the economic cycle. However, the magnitude of that difference is actually still quite muted. So we have in our ER portfolios, we have actually taken emerging markets in China back to market weight back in December, but we're not yet ready to take it to overweight. So we're not like kind of outright bullish about emerging markets in China. First reason being like what I mentioned, the magnitude of that outperformance is not that great. Secondly, if we are seeing a US recession in second half of this year, then given that the US economy still has significant impact on emerging markets in China, it's very hard to see like absolute performance for emerging market assets.
Yep. On that point, we have a question from one of the listeners here. Wei Chuan, he's asking, how do you expect StashAway's portfolios, or how do we expect them to behave in the current environment?
When we design our StashAway portfolios, we always optimize them according to the SRI, so the StashAway Risk Index, which is a very, very good way to think about the risk of your portfolio. For those who are new to our platform, the StashAway Risk Index basically measures the drawdown, the maximum drawdown of the portfolio in 99% of the time over a 12-month period. Meaning that, let's say you have an SRI 10 portfolio, which is quite conservative. Over a 12-month period, there would only be 1% chance that your maximum drawdown would exceed that 10%. So when we did the reoptimization back in December, when we rebalanced our portfolio, we also rebalanced according to each portfolio's SRI level, taking into account the prevailing macro condition. Now, the macro condition that we're in is it's still a stagflation, meaning that growth is contracting in most major economies, while inflation is still very high, but it's actually coming off. So what does that mean for our allocation? For example, we've actually significantly increased allocations to short-dated US Treasuries, which are offering very high interest rates, right? And 4.5 to 5% interest rates. And these are very, very steady, very low risk instruments. They provide a good bedrock for any portfolio, given the uncertainty in the macro environment. Secondly, we've also kept our allocation to gold, which is also a good balancing asset in turbulent times. Indeed, if you look at historical performance of gold during equity drawdowns, they have actually on average returned positively. I think thirdly, as I mentioned, we've actually increased our weighting to emerging markets. So it's more market weight that benefits from diversification of our exposures and also helps to protect us from a US potential recession. Lastly, within equities, we've also moved a bit more defensive, but also rotated a bit more to kind of the tech sector, and that actually helped us to have some outperformance in the equity side in first quarter. I think I guess at the end of the day, we're trying to design portfolios that help everybody to stay long-term invested. So even during turbulent times, you can expect your portfolio drawdown or maximum drawdown to remain quite constant. And that's why we optimize our portfolios, because if you think about investing in stocks, right, in good times, the risk of stocks are lower, whereas in bad times, the risk of stocks, i.e. The maximum drawdown, would be a lot bigger. And as investors, you don't want that risk to change as the macro environment changes. So that's why we construct portfolio to try to keep that risk quite constant.
All right, thanks, Stephanie. There is an interesting question here, which is kind of relates to what we've been talking about earlier, where U.S. versus China, or U.S. versus the rest of the world. This question here is asked, hi Steph, can you comment about the risk of de-dollarization to StashAway's investments? Are StashAway's portfolios ready for this de-dollarization trend? I think, Stephanie, let's perhaps address the question as to what de-dollarization means first, and then what that impact has for our portfolios.
Yeah, I think I'm getting this question a lot these days. De-dollarization, as kind of defined by mass media, means that the US dollar actually loses its status in global stage. Meaning that, maybe central banks no longer use US dollar as a reserve currency. Maybe we don't trade using US currency. You've seen China having trade deals with different countries to use the renminbi, for example. So I think if we take a step back, I think it's part of a kind of a more major kind of global trend that's going on, which is kind of the multipolar or bipolarization of global power or economies. So if we think back since World War II, the U.S. has been the dominant power, right? It's a unipolar world where there is a consensus to follow U.S. standards. I think in the past few years, what we're seeing is a gradual deviation from that. Of course, the biggest kind of bipolar I guess players are US and China, but I mean there are other regions that are kind of starting to think about their own agendas too, right? Europe or Japan, I mean they all need to think about, what is my place in this kind of bipolar or multipolar world. I would encourage everyone to actually take a look at Ray Dalio's articles or books, or he's got very good YouTubes where, I mean, he described I guess throughout human history what happens when you see a shift in the greatest power. And I think in conclusion, it's a very, very long process. It doesn't happen in 1 year or even 10 years. It happens over multi-decades. So taking it kind of closer to the question of how does it impact StashAway portfolios, we actually always take into account currency as well when we optimize our portfolios, particularly for markets that are not tied to US dollar. For example, like Singapore, Malaysia, and Thailand, we have specifically designed portfolios to these different countries so that we actually optimize our US dollar overweight or underweight according to the regime. So for example, right now we are kind of more neutral US dollar. So the exposure of your portfolio to US dollar is actually anywhere between 30 or 50%. And the reason why it's not 100%, you may think, I'm depositing US dollar. Why is it not 100%? But much less than that is because even though we buy the ETFs in US dollar, the underlying companies are actually not all US companies, right? For example, we have an allocation to, I guess, global equities ETF that is listed in US, but within that global equity ETF, it has companies that are listed everywhere, right? In Europe, in Japan, in China, etc. So when you invest in these companies, you're actually enjoying the earnings that they earn in the local currency. So in a sense, I mean, you're actually exposed to their currency instead of the US dollar. So so that's why when you invest in StashAway portfolios using US dollar, it's actually not 100% exposed to US dollar. It's actually way, way less.
All right. Speaking of another component that's in our portfolios, gold itself, we've seen gold prices at I believe last I checked was about $2,000. What we've seen it move up quite significantly ever since the Russia-Ukraine conflict. So Eugene here has a question. He's asking, given that we have gold, given the possibility of an impending recession, what are your predictions of the near future? Is it really something that we should continue to still hold going forward?
Yeah, I mean, we actually have gold in our allocation, or we increased gold in our allocation back in 2021 when we saw that inflation was actually increasing, or the risk of inflation is rising. And since then, we've actually kept gold as a significant allocation to our portfolios. I would say that, I mean, if we think about kind of when would gold be performing, there's actually a few ways to think about it. Number one is the inflation picture, or if you take inflation and interest rates, are interest rates actually positive or negative if you adjust it for inflation? The second way to think about it is by a US dollar, actually, because I mean, gold is actually priced in US dollar. So when the US dollar is stronger, gold would not perform that well, and vice versa. So if you look at gold last year, in 2022, it was actually, I mean, a decent hedge versus equities and bonds, right? Because both equities and bonds were down kind of mid double digits, and gold was pretty much flat. This was actually despite a very, very strong US dollar environment, which shows you actually, I mean, gold was hedging against the inflation risk. Now this year, we think actually, I mean, inflation is still going to be rather high compared with historical standards, but it's actually coming off. So the inflation risk is receding, but also at the same time, US dollar is not strengthening as much as last year, particularly when the Fed actually start to pause. So, I mean, that combination actually means that, I mean, gold would have a pretty good chance of being a kind of a good balancing asset, or outperforming equities at least this year. Bonds is a different story, but I mean, I'm happy to go into it. But I think for gold, if it would be a good kind of hedging asset versus stocks.
All right. A more, I guess, specific question relating to our portfolio offering itself. So this question is by Wei Chuan. So he's asking, since there is still a prediction of the Fed increasing interest rates to curb inflation, and this could possibly lead to an eventual recession, is StashAway's passive income portfolio still wise?
So we launched the passive income templates in the Flex portfolio. And I mean, these templates are designed to help our investors to actually capture income from a long-term perspective. And they make up of a very well diversified set of income sources, including government bonds, corporate bonds, long-dated bonds, and short duration bonds. I would think that, I mean, if you compare the return of these or yield of these portfolios, I mean, they're like kind of 4 to 6% right now. So I would think that, I mean, in an environment where interest rates are actually starting to taper off, meaning like we're close to the Fed's kind of end of the Fed's rate hike cycle, this is actually not a bad kind of return target to have, particularly for the long duration bonds, I think. So, I mean, there's a few moving parts here. Number one is the short duration bonds are generating a very, very good yield. For the long duration bonds, I think as the year progresses, particularly if we get into recession, these bonds actually not just benefit from the income that they generate, but they can potentially benefit from the price appreciation, because as interest rates come down, prices of these bonds actually go higher. But I guess on the other side, if there's a recession, there's also a risk that the corporate bonds, the corporate bond spreads would actually widen, meaning corporate bonds may not do as well. And I mean, of course, these are all kind of designed kind of as a diversified portfolio, so that no matter like what kind of condition you're in, I think these portfolios would give you some sort of stability. Now, we launched this Flex portfolio because actually we wanted to allow people to have more flexibility in kind of adjusting their allocations. So I would encourage, I mean, if you have interest or if you like to kind of be a bit more active yourself, you can play around with the allocations itself. If you're not comfortable with like the corporate bonds, so you can dial it down. If you like the short dated treasuries more, you can dial it up. So it's a starting point for a good long-term portfolio, I think.
Yeah. So these flexible portfolios, they're really meant to allow you to tailor them in any way that you like. And a shameless plug here is that, do feel free to try them out, because there's no fees that we will be charging on them until the end of June. So yeah, do play around, explore with it, see what suits you best. I think that comes to the end of the session. We are past a little bit the time. So thank you so much, Stephanie, for answering the questions. Thank you all to our listeners for presenting your questions to us. We will be doing this again, so do stay tuned, and yeah, take care, everybody.
Thank you, Albert, and thank you, everyone. Have a great night, and we'll see you next month.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store, so you can start on your financial journey right now.